Good day, ladies and gentlemen. I hope you're well. So today's live stream is built around three macro inputs that decide the next phase for Bitcoin and risk assets, including Nasdaq's crypto ETF option market cap removal, US jobs data, and CPI. First, we'll be talking about Nasdaq and the SEC. Now, this is a quiet market structure story most people have missed. The 25,000 contract position limit on certain ETF options like Bitcoin and Ethereum, ETH has got moved via exchange rule changes. Now, this matters because it expands how large players can hedge and manage risk in crypto. On the 29th of July 2005, IBIT options increased from 25,000 contracts to 250,000 contracts, giving more large flexibility for big players to scale up their positions. Now, that was last year. Now, the Nasdaq IS, which is one of the marketplace where IBIT can be traded, filed on the 7th of January to remove this 25,000 options trading limit it had on exchanges of ETFs, crypto ETF options. Now, the SEC posted that filing on the 21st of January. The comment period ended on the 26th of January and approval was granted on the 17th of February. In regulatory terms, that's pretty quick. Often rule change takes months, and we'll be getting into that, especially the controversy and if there's any feedback, which there hasn't been. It just shows that the SEC is more open and involving in crypto market structure movements. We'll also be talking about jobs. Now, the US January jobs report was released on the 11th of February 2026. The US jobs market added 130,000 payrolls in January. Sounds fine until you remember the real story is often in the revision. The BLS, or the Bureau of Labor Statistics, has shown how volatile the narrative can change after revisions, which is why we treat job data as headlines first and credibility second, because the BLS, Bureau of Labor Statistics, routinely revise in the next 2 months. And sometimes the benchmark revisions can be massive. The first print was more of a sketch, not the final answer. So we'll be talking about jobs. And the last thing that we'll be talking about is CPI, which is coming in tomorrow. CPI is inflation data that drives rate expectations, liquidity, risk appetite. It also has an immediate impact on markets. We'll break down what CPI actually measures, how the CPI basket gets updated over time, and why inflation can cool on paper while the real life still seems expensive. Then we'll tie it in all together into rate cut expectations and what that can imply for Bitcoin and crypto, especially in a bear market regime. So we'll start off with the Nasdaq, then we'll move on to jobs, and then we'll go on to CPI. Bill,
Hi.
Welcome to the show. Thank you for joining us today. How are you?
I'm good. Thanks for having me.
Awesome. Just quickly, just before I go on and do the second bit, I just want to check who's in the comment section. Nightbot is in the comment section and very active. We have Black Hat Team, John Legend, Mark Volmer, and we have a couple of other people watching. Actually, we have quite a few. If you want to pop in and say hi, that would be great. Just very quickly, for those who are watching, could you please repost this stream on X. I'm getting a banner up here saying X is experiencing issues with live stream posting. So if you could do that, that would be much appreciated. Before we talk about this 25,000 cap that has now been removed, we want to know what option trading really is. Option trading is basically a way to bet on which direction the market will move. If you buy a call option because you think the price will move up, you set the price, say at Bitcoin being at 100K, 100,000. If the price then rises to 120,000, you then profit from that $20,000 dollar increase. I should do it in dollars, shouldn't I? On the other hand, if you buy a put option because you expect the price to fall and you set it at $100,000, if the market drops to 80,000, you have the right to sell at 100,000, effectively gaining that $20,000 difference. That's trading options or option trading. What they've done is they've removed the cap on the limits. Previously, a single participant in the NASDAQ could hold up to 25,000 option contracts total at any one given time. That's not per day, but that's their maximum open position. Once they hit that limit, they couldn't take on any more contracts. After the cap was removed, there's no longer this limit. So participants can hold larger option positions if they want to. So why did this cap exist in the first place? Well, there was the cap of the 25,000 contract position limit on options for crypto ETF related products like Bitcoin and ETH. The cap existed in the first place because position limits existed to reduce one participant getting a very large share or getting too much share of the market. It also existed to prevent manipulation, especially around the expiry. It also existed to help with stabilizing the market. And that's the whole philosophy of it. If a single participant can dominate open interest, they can distort the market. So the cap wasn't random to begin with, it was a safeguard. So the question now is, Bill, if it was there in the first place to prevent one company from dominating and to prevent market manipulation, is removing it a safe option, bearing in mind many companies in the NASDAQ have billion-dollar market cap valuations, and a few even have trillion-dollar market caps. Bitcoin's market cap is just over $1 trillion. I think it's 1.3 trillion at the moment.
Yeah, I think it's safe to allow this derivatives trading safe because, as you noted, every other big stock or every other big ETF has this. The Bitcoin ETF is not some like new immature thing. It's a big deal. It's BlackRock's most profitable investment. So you want to have the most liquid derivatives market possible. Now, the question is, why the sudden rush? Why is everybody going, oh, wait a minute, we need more derivatives. We need more hedging, right? What you use options for betting, leverage, right? And hedging. And we'll talk about some of that. So if somebody is making an urgent request from the SEC to expand options trading, you can translate that into English by saying someone is asking for the ability to buy large amounts of Bitcoin price insurance. You talked about it with a put option. Now, this could be because some big player is getting liquidated their creditors could be receiving large amounts of the Bitcoin ETF, and they don't want to just dump them into the market. They want to hold it and protect themselves, right? Just buy the insurance and try to get out of the position slowly. But if they can't get insurance, they might have to dump the whole thing into the market and create an even more disorderly situation. So I think this change is being driven by an immediate demand for insurance on the part of somebody who's losing money. Now, let's be slightly optimistic and pretend it's not a forced liquidation. Let's pretend it's someone like the Harvard pension, like the Harvard endowment, or even a pension fund. Pension funds really can't buy anything unless they can buy insurance on the price. Honestly, it's like it's like a violation of their fiduciary duty if they actually buy something and can't get insurance on downside. So this will allow larger and larger players to come in, buy Bitcoin, and get downside protection. That's the legacy jargon. As we always discuss on the show, legacy has, jargon for everything. It's called downside protection. Now, again, the rush, well, everybody said Bitcoin's stable, Bitcoin's digital gold. Bitcoin wasn't going to have these like 60%, 70% swings. Well, guess what? Obviously, right? Bitcoin reveals that it can move 50 to 60% in a clip. And that has likely made ETF players nervous. It has probably also got BlackRock's attention, whereas BlackRock calls the SEC and say, our most profitable product that we marketed to a lot of people, they may need protection here. We may need protection. So that's angle number one. Angle number two is that everybody who's currently losing money in Bitcoin, their strategy is this is the most common option strategy, is if you own something, you go to the bullish bets, the call options, and you just short them. Now, what does that do? Well, if Bitcoin is at 70 and you sell that bullish bet at 90, if Bitcoin only goes to 80, your bullish bet that you shorted goes to zero, and you just collect the money. It's a way to get yield on Bitcoin if Bitcoin is not going parabolic. So if Bitcoin is just trading normally, all these people who are underwater can, get a little yield, rebuild their P&L a little bit by selling all these bullish bets. Now, in your mind, hopefully there's like a bell going off, because this is a little bit like what happened in silver. What happens if everyone wakes up one day and goes, I think we want Bitcoin the way we wanted gold and silver, after all these characters have shorted bullish bets? You can have a situation where somebody, they still own Bitcoin, okay? But as Bitcoin kind of turns and really ramps and goes up, they're losing profit at an accelerating rate. So it's like, the more Bitcoin would go up after everyone shorts the bullish bets, the more they would have to buy. They have to buy their options back. The options market makers, right? Because you don't go to the strawberry patch and pick options. You have to get them from a market maker. So in this type of situation, they call it a gamma squeeze. If everybody like Metaplanet and MicroStrategy goes out and says, oh yeah, we're going to short these bullish bets because we like Bitcoin, but we don't think it's going to go up anytime soon. Uh-oh. If Bitcoin did go up, there'd be all these players having to, like, literally, it's like accelerant to the rally. Now, I don't want to go into too much at once, but I think the initial demand is for insurance and overriding to create yield, right? I mean, because all these players like Metaplanet, it was the first thing they said, well, we lost money on Bitcoin, but we're going to use the options market to get yield on our position. those are, insurance and overwriting.
And options, I mean, you can have them in bull and bear markets and sideways markets, but when do people use them most? Is it, or do they just use them at any time of the cycle?
Okay, well, I think the most common thing is to just own it like a hodler or a plain vanilla person is what they call it in equities, right? Long only, just like a mutual fund. So the most common thing is to sell the options on the upside to collect a little yield. It's mechanical. It's a no-brainer, right? If you have to cover the options, you might do that 10 times and have to cover the options once if it goes parabolic. It's very simple. Now, as you noted, when things get serious, when things start going down and when people start getting nervous, that's when they all go looking for insurance. Now, naturally, that's when insurance is expensive. So the game is like, you should buy the insurance when Bitcoin is actually going up, right? If you wait until Bitcoin starts going down before you buy the insurance, you're going to pay a lot more for it. So, fear brings hedging. And, there is a saying about hedging, which I won't say on the show, but frequently people hedge at the wrong place at the wrong time. Let's just put it that way.
Okay, so another thing that another thing that I noticed was the SEC, so that's the US Security and Exchange Commission, and it's the top security regulator in the US. It oversees like markets and broker deals, exchanges, ETF, a lot of things that happen in the modern, financial industry. And its leadership matters because under Gary Gensler, the SEC's position towards crypto was widely viewed as very enforcement-led, very restricted. Now, that changed in April 2025. Paul Atkins became the SEC chair. He was sworn in on the 21st of April 2025. Now, I'm not sure if you like Atkins or not, but the market broadly reads him as being more market friendly, more open to building a clear framework than the prior era. And obviously we can debate politics until the cows come home, but changes have mattered because obviously it was on the 7th of January the Nasdaq did the filings to remove the cap. And it was on I think it was 21st that it published them. On the 26th, they had the comment deadline, and then on the 17th of February, which is very, very fast, the cap got removed. So the rulings like this normally used to take months. And I think they would have taken a lot longer under Gary Gensler. So this moved really, really fast. There's no doubt about it. Now, is that because the SEC is generally more efficient under Paul Atkins? Are they cutting corners, or are the regulators just treating this as all the risk concerns have been done, they've already been resolved, and they're just basically waving things through now?
Yeah, I think there's an element of everything crypto related being waved through. I think there's an element of what BlackRock wants, BlackRock gets. I mean, if they're the ones that are asking for it, they're getting it. And then I think you also have to remember that, Trump's kids have a Bitcoin mining operation. Miners, like in gold or farmers or oil producers, they use these instruments all the time. So, one of Trump's business entities in crypto could have needed this options trading ability. So, I mean, Atkins is really there to just sort of wave everything that can't create any consternation through the market, right? They're not doing, they're not doing the, the Cardano ETF or the XRP strategic reserve. They're not doing that. But if somebody wants to trade options, they're like, okay, yeah, go trade options. Sure. Right. Especially since BlackRock wanted it. And especially since, like I said, Trump's kids have a Bitcoin mining operation. If Bitcoin's going to go to what, if people are afraid Bitcoin's going to go lower, they need that trading capability. Not to mention, so do characters like Michael Saylor. They don't want Michael Saylor to blow up. Bitcoin, no matter what anybody says, and I know people hate this, gold and silver are associated with the Chinese. Bitcoin is associated with the United States. I know that that's not what people want, but that's the marketing and the brand at the moment. So it is not in our interest to see, a disorderly, usual bear market nuke in Bitcoin with legacy institutions involved.
No, that's very true. That's very true. If we go back to the manipulation part, because you've just mentioned Trump, and it just came to mind again. So this cap originally existed to stop things like market manipulation, especially when it came to like near enough the expiries, etc., for the options. What we have is we have two things. We have massive companies with billion-dollar market caps, even trillion-dollar market caps, now able to buy Bitcoin, these options. So we don't, the cap existed so one or a couple of companies or big players or institutions couldn't take over a large part of the market. They technically on paper they kind of can do if they wanted to. And then, the other thing is actually just manipulation and inside trading, which we know happens. It even happens in, TradFi and all the rest of it. And there's been many fines going around in the past as well. So where does market manipulation come in with this cap now being removed?
Okay, let's try this. Let's start with a question. How does the Fed prevent the stock market from going down in a meaningful way? Like, a mega crash. It's very simple. It's actually, you can look this up. There's a group called the Plunge Protection Team. And what they do is they go into the S&P options market and they take all the bearish bets. Remember how I told you all those bearish bets start getting expensive? And they just short them in large quantities. But of course, that's an infinitesimal amount of money compared to the $16 trillion worth of stocks that are traded, right? They just go into this options market. And what happens is when they short the bearish bets, keeping the finance to a minimum, it creates automatic buying from market makers. So central banks, which have hugely deep pockets, can just come in all at once and stop a decline, or at least pause it using the options market. Done all the time. Every time the market would go down 5%, they would come into the options market and then Bernanke would start QE. Now flip it around. Let's say Bitcoin is going up so much that it's embarrassing governments. Central banks can come in and go to the bullish bets and just short them in huge quantities to try to create this automated selling pressure to try to blunt the rise of Bitcoin. In other words, this strategy that people organically do who own it, central banks can just come in and just stop it temporarily using the options market. So does it open it up for manipulation? Sure. Right. But most of this stuff is manipulated anyway by bigger players, right? Like, futures in the 70s was a bunch of plumbers and entrepreneurs trading their own money in a pit, making hand signals, buying and selling, writing their position down on trading cards versus gigantic institutions at Wall Street. Literally, they were called locals, locals versus Wall Street. So locals all thought it was manipulated, and it is, because the big players can move it around. Big players moving markets around is not new. I think at the moment, I would choose to think positive, that it's actually a sign that people are too bearish and too scared, that everybody wants to buy insurance after Bitcoin is down 50%.
Mm-hmm.
No need for Bitcoin insurance when it's at 125, but it's 60. Oh my God, I got to get insured in case it goes to 30. It's a sentiment indicator.
Mm-hmm. Mm-hmm. So what does this all mean for Bitcoin? So the change automatically doesn't pump Bitcoin. It's not bullish news as in price goes up. But what it does do is it changes how big players behave, and it changes the way that the market moves. Institutions can hedge now at scale. With the cap removed, they can option at much sizes. It gives them more tools, it gives them bigger positions. Also, large funds can manage risk more calmly and more effectively. So more liquidity, more participants, better price discovery. Removing the cap doesn't stop margin calls. If somebody's over leveraged somewhere and the price moves against them, they can still get forced to add collateral or close positions, but it can help institutions hedge earlier and more efficiently, which does mean maybe less panic selling in spot. Maybe a lot more stress can be resolved through these options. What are your thoughts on how this will affect the price of Bitcoin moving forwards?
It's good for Bitcoin. Listen, anything that creates more liquidity and more volume makes the market go up. If you improve liquidity and improve volume, the markets go up. And this is particularly true in legacy, where you don't want entities like BlackRock having to go to some semi-sketchy over-the-counter market to get insurance. You want BlackRock or Galaxy Digital to market Bitcoin as an asset that's undervalued to pension funds, mutual funds, and all these big players and say, hey, you guys can buy this down 50%. Meanwhile, in stocks, you have major problems developing because AI is disrupting software. Like everyone's just now discovered that trade. Like, oh, wow, AI is going to change the way we do things. Well, the only thing that, doesn't get hurt by AI is Bitcoin, because Bitcoin cannot be replicated by a chatbot. Bitcoin is the only moat, as one guy says, in business. It's the only thing that still has a moat around its castle. No one else does. So if you're reading this, and I'm reading it, I used to work with this guy. His name's Jordy Visser. If we're reading this and software stocks are crashing, you call these institutions and go, maybe we should move some money that was in Microsoft over to Bitcoin. Really? Do you have options? Can you do that? Yeah, we have that. It makes it easier. It makes it easier for big players to invest. And I think the manipulation concern, you know what? We would love to live in a world where central banks had to try to use options to stop Bitcoin. If it ever comes to that, good luck. Did they stop gold? Did they stop silver? No. I mean, yeah, they eventually did when it got overextended. Okay. But we all know that what can happen with Bitcoin because of that, sort of like limited supply issue. And also that, unique software capability. It's digital scarcity in a world where there is no such thing anymore. So central banks trying to stop Bitcoin from going up, boy, that'd be a lot better than 67K. I don't know about you.
Okay, let's talk about the Fed. So the primary goal of the Fed has always been to control things like interest rates and monitor the job market, and then obviously foster economical stability. Specifically, they aim for two core mandates: maximum employment, making sure as many people as possible who want jobs have them, and to stabilize prices, keeping inflation in check by adjusting interest rates. So we're going to be talking about jobs, because this is where the market loves to get hypnotized by headlines. Now, the latest US job report was released on the 11th of February 2016. The headline said, we've added 130,000 jobs in January, but there is a problem. Payroll is one of the most revised data in macro. The first print is usually a rough estimate. The story often changes a month later, and then it changes again the month after that. So whenever we hear things like jobs have come in strong or they've come in weak, the real question is not just the number, it's like how trustworthy that number is. Because last year we had revisions that were absolutely brutal. So for the previous 12 months, ending in March 2025, the bank mark revision showed the US had about 911,000 fewer jobs than previously reported. It's not near a million, but it's quite close to it. And then in March 2025, job roles levels itself was revised down by 889,000. That's not a small adjustment. That was an entire narrative rewrite, and that was brutal. Headline jobs or job headline numbers is marketing. The revisions are truth. Now, this matters for crypto because jobs print is what traders use to price the Fed's path. If jobs look hot, rate cuts are less likely to occur, liquidity stays tight, and riskier assets like crypto and Bitcoin suffer because hot jobs market is too strong. There's lots of hiring, there's strong wage growth, low unemployment, and it keeps inflation sticky. Sorry, I forgot the word just then. But then if you look at soft, the market starts to front run costs because soft jobs means that the job market's cooling, there's slower hiring, rising unemployment, weaker wage growth, blah, de, blah, de, blah. And this can reduce inflation pressure. So jobs isn't just about how many people got hired. Jobs is a cutting rate betting market. Even when unemployment rates looks low, it doesn't automatically mean the economy is healthy for households. People can be employed and still feel broke. Jobs can be concentrated in a few sectors. Hours can be cut. There could be second job rises. A lot of people nowadays have second jobs, and the cost of living can keep doing a lot of damage. The headline may look fine, but the revision and the structure underneath is where reality really sits. If that makes sense. So last week, just last week, no, actually it wasn't. It was the last week of January. In the last week of January, UPS said that it plans on cutting 30,000 jobs. Amazon said that it was going to cut 16,000 corporate jobs. Pinterest announced layoffs of about 15% of its workforce. Citigroup reported an additional layoff of roughly 1,000 jobs, and more are expected later. So the January job reports came out on the 11th of February. It showed this super number 130,000 payroll numbers. But how much weight do you actually put, or how much weight can we actually put on the first print version versus the revisions that will come over the next 1 or 2 months? And no, I don't think there's going to be an alt season, by the way, whoever's that. So we can't judge. The other thing with the jobs data is we can't judge the quality over quantity. For example, full-time work, part-time work, second jobs, hours, hours work, wage growth from the jobs data. What do you think is the cleanest way that we can really see what's going on with the jobs data?
Okay, with any economic statistic, you don't look at the market reaction the day the number comes out.
Mhm.
Most of the time, Wall Street economists develop some sort of expectation They aggregate the estimates from all the economists. It gets plugged into a trading algorithm. The news headline publishes, and the algorithms just trade the headline versus what was expected. It's a robot show the first day of any number, especially payrolls. Now, if you want to know what's actually happening, you used to be able to look at the interest rate markets. Like the most sophisticated economists, the most sophisticated markets for figuring out what goes on with these with economic data is the bond market. Now, the bond market is now this, very strange, illiquid, quiet place, even though there's all these trillions that have to be issued. But looking at changes in interest rates is the best way to understand what's going to happen with the number, not what the Fed does, what the bond market does. Because remember, the Fed only controls the overnight lending rate between banks. It doesn't control the mortgage market. It doesn't control the long bond. It doesn't control really the rate that you pay on a car loan. That stuff's set by the market. All right. That said, now in the United States, there has not been real full-time job growth in a while. Most of the numbers were obviously manipulated under the prior administration. The federal government's payroll was huge. So all the hiring that's gone on was either a statistical mirage or done by the federal government for at least 6 years. That's all been unwound. Supposedly, the federal workforce is as small as it's been since 1966. So if you have, the government laying people off and these big tech firms, right? These big tech firms are spending wildly on AI. Meta is building a data center in Louisiana, the state next to Texas. That data center is larger than the island of Manhattan. It's bigger than New York City. Okay. So they are spending an indiscriminate amount of money, borrowing an indiscriminate amount of money. Oracle got in trouble for this. So what is the biggest expense of every company? Heads, right? People, benefits. Okay. They just have to open the door and let everyone go, right? Now, there is also the argument. There's two arguments. One of them, there was like kind of an end to a fashionable, let's call it a social-based hiring policy that kind of went out of fashion. And then there's this idea that every project manager and everybody who works with a spreadsheet and everybody who works on a laptop is going to get replaced by some sort of AI agent. They're not going to wait for the agents. They're just going to do it now because you know what? They have to spend money to get the agents up and running. They have to get the data center. I mean, they could turn on the omnipotent computer tomorrow. They have the software. They don't have the hardware, right? This is where money is getting spent. It's not getting spent on people. It's getting spent on machines. So if you look at this, yeah, everyone's got to have two jobs. Okay, inflation may or may not have stopped going up, but prices never went down, right? And I went to Costco the other day. That's a huge wholesaler where you get to buy stuff in bulk. I don't know, a case of 12 protein shakes went up 10%. I'm standing there looking at it and goes, wow, my personal CPI is 10% today. Because, that's what happens when prices jump. Now, are they measuring this in CPI? I don't know. You can have CPI without food and energy. They call it X food and energy. Okay, well, most of what people spend money on is rent, food, and energy. Are these numbers real? I mean, we'll talk about inflation, but are these employment numbers real? I don't think, I can tell you this. So I interviewed with, let's just call it a major technology space company. I made it past the second round. And the question is, was I going to go to the third round? Now, I didn't make the third round. And this is typical. I'll get somewhere And then you'll find out at the end, there's you and 4 other hyper qualified people for one job.
Mm-hmm.
I mean, I know for a fact, like at Tesla, you'll have technology people will have 6 or 8 rounds. My final interview with that company would have been with the head of the business unit, like the top guy would interview you at the end. That's the last interview. So the competition for any type of what I would call real job in the United States is unbelievable. It's absolutely unbelievable because there's no job growth. There may not be massive layoffs. There are layoffs, but that doesn't appear to be a disaster, right? I mean, unemployment rate actually went down. It's not terrible, but it's not what we're used to. It's not good. And it's why housing affordability is terrible. Okay. It's why people are so depressed. Because I think unemployment amongst young men in England is like 17%.
Mm-hmm.
You know what
Mm-hmm.
I'm saying? Like there are these demographic unemployment pockets that are disastrous, right? Literally. So it's not just one number. You have to dive deep. And I think at the end of the day, Powell locked up housing with a 6% mortgage rate. Housing is broken. It's broken. And I think this jobs market, which complicates that, right? Nobody can qualify for a mortgage. So the payment's too big. And even if they could make it, they can't qualify. That little loop has to get fixed. And it will get fixed. At the moment, Powell has an excuse to be stubborn because even though we all know it's not good, the numbers are not terrible. And the revisions and the fake numbers are expected and known. It's not like, oh my God, what a shock. The numbers are all fake. You don't know if the numbers are, you don't know if they're not fake now. You don't know. Like you got CPI tomorrow. I mean, does Donald Trump want a hot inflation number out there? If it's still a little hot, I don't, you know what I'm saying? I don't know. I would say no.
Mm-hmm.
So, I mean, we'll see. You gotta rely on the bond market, I think, when it comes to these numbers.
God, it is echoed in the UK so much. It is so difficult to get a job, not just in the UK, but I know somebody who was hiring in Dubai, and he said that the level of people who were after, who were applying from the job, he thought that he found the absolute peak. Nobody can ever beat him, the ceiling, and then 10 other people would apply, and each 10 of them was better than the one before. And then over in the UK, because we have this job issue, we also have, unfortunately, especially for young men, we have a very, very serious mental health issue for them as well, which is quite sad, actually. We could talk about jobs all day, but let's just quickly touch upon CPI, because that is coming out. Now, the CPI number decides the narrative for liquidity, for rates, and for risk assets. And we might actually cover this a little bit more next week. But what actually is the CPI? So CPI stands for Consumer Price Index. It's a monthly measurement of how price is changed for the typical basket of goods and services that households buy, like you were saying, shelter, food, energy, transport, medical care, and more, medical care and more. So it's not just a chart for traders. It's literally the cost of living price gauge. Now, the key thing that people argue about the CPI basket, and the weights are not frozen forever. They get updated over time to reflect how people are actually spending. And that means that the index is designed to stay relevant on paper, but it also means that people often feel like the official number doesn't match their real lived experience, their reality, because things like shelter, insurance, and day-to-day essentials can change, which makes the number seem better. because as people adjust their shopping baskets, people will adjust their shopping basket because of the budget that they have and to get ends to meet. So without a doubt, the CPI is flawed. Now, after COVID, inflation ran hot and CPI levels went above 9% in 2022, which was a bear market for crypto, but also we had the cost of living crisis as well. That's the inflation wave that smashed household purchasing powers and forced central banks to aggressively adjust rates as well. So it is a gloom and doom reality check because even when the CPI comes out, it doesn't mean life is suddenly more affordable today. If prices rose sharply for 2 years, a lower CPI number today just means prices are not rising as much; they're just rising slowly. So but that doesn't mean that we've returned to where we were. So for normal people, it can feel like things are getting worse, even if the official inflation rate is falling. Now, the latest CPI data were last month, and they were released on the 13th of February. Now, the headline CPI was for January 2026 came out at 2.4% year over year. And that was down from 2.7% year over year in December. Now, core CPI, which strips away food and energy, was 2.5 year over year. So why does the CPI move markets so aggressively within minutes as soon as it comes down? And often what we see is even if there's good CPI, the markets will fall. The markets kind of sometimes tend to do reverse, and then they will change directions and go the directions that they were meant to be heading after a couple of days or a couple of hours. So why do markets move CPI so aggressively and so quickly?
Okay, so this was the big number for Powell, for the tightening cycle, and the unwind of the tightening cycle was, what's the inflation number? So Wall Street doesn't necessarily wait, particularly in a big tightening environment, to sit around and go, well, we're going to wait for the number to come out before we make a decision. Frequently it's like buy or sell the rumor and then unwind it on the fact, especially if it's these numbers are, dramatic points for Fed policy decisions. Now, in this particular case, I think what would be perfect is to show that inflation is just reasonable, so that, believe it or not, people like the president or even people like the Treasury Secretary can come in and actually talk inflation down. Because when people think inflation is hot, they go out and panic buy stuff. They make it worse, right? If you can talk inflation down, if you can keep what they call inflation expectations, what people think is going to happen to prices, is actually more important than what happens to prices, because it's about their behavior. Now, hopefully what we can sell to the public eventually is this idea that AI is not only an economic accelerant, but it's an accelerant for deflation, right? If you don't have job growth and, AI and robots can do it faster, better, cheaper, this puts a lid on traditional inflation. It puts a lid on it. So people may look at CPI tomorrow. CPI does not impact the fact that, the price of beef in the United States has like 3x'd. It's not going to change one way or the other. And hopefully the narrative switches to, I'm miserable because prices are high, to, hey, wow, AI can do this cheaper. Like, for example, even though it's tragic for the truck drivers, battery-powered robot trucks delivering goods drops grocery prices 10, 15%. Truck drivers in the United States, if you were for Walmart, your truck driver, you can chatbot it later. Those guys were getting paid six figures 5 years ago. Now, they're going through tough times as well, but I mean, if you automate logistics, prices fall. Walmart's going to be a gigantic robot operation one day. It's going to be nothing but robots. Low-cost provider. So, okay. Is CPI a big deal? Yeah. If CPI is hot and we can't get immediate Fed rate cuts, the market may get wound up about it. I think inflation as an economic issue is dead. As a market policy, it's dead. And it's not dead to me and you at Costco, but it doesn't matter because this AI trade is now pervasive. It's everywhere. It's moving equity markets. And this idea that no one has a moat, prices are going down, and, AI is like, is an accelerant for business, for everything. This includes decentralization and crypto. So all the old math is going out the window. If you don't believe it, like what happened to software stocks? This is like the shot heard around the world. Let me share this because people may not fully believe this. Like when it comes to inflation, that's like old thinking. These are software stocks. Now we knew AI was going to change software, right? Right?
Mm-hmm.
Well, apparently not, because the software ETF went from 107 on January 7th to 79. This looks like an altcoin. It's an ETF of giant software stocks. So how are we doing on inflation here? Does this look like inflation to you? This looks like a disappearing act, a complete reorganization of economics. Okay, so yeah, does it matter? Yeah, we need rate cuts because housing's messed up. So if CPI gives a new Fed chairman an excuse to come in, or it gives Powell a chance to do a rate cut on the way out, that's the most important thing, right? Really, I just did this 10-minute speech about how it doesn't matter. Now, how it matters is if it gives Powell an excuse to say, okay, let me give you one rate cut on the way out the door, so I don't hand the new guy a total bag. Maybe that's wishful thinking. Or it just gives the new guy ammo to come in and immediately. That's why Trump is trying to say inflation is dead. Inflation is dead. They're trying to get those rate cuts to save housing. I hope they get it.
Mm-hmm. Okay, so that was our stream for today. We touched upon many things, including the NASDAQ and the SEC, the removal of the options cap, what that meant for the growth of Bitcoin, the growth of the space, what it meant for risk, for larger players, what it meant for hedging, risk management, all the rest of it. We spoke about jobs and then also CPI as well. Coming up on Thursday, we've got a cycle check where I'll be going through the Bitcoin cycle to find out where we are in the cycle. We'll be looking at a lot of on-chain and off-chain data. And then next week, me and Bill will be here again on Tuesday. That's brilliant. Thank you so much, Bill. And thank you for everyone who's been watching. And I will see you next week.